morning, Stocktwits Nation. We missed you, but we are back. Shy, what's up? Happy Cinco de Mayo. Happy earnings week.
Oh my
How
god,
are
you
you
just
doing?
you just reminded me it's my mom's birthday today. I'm actually gonna text her right now, real quick. I completely
Aw.
forgot. I'm such a
Give
bad
her
son.
an
I'll text her
honor
after though.
shout out so we can clip it and she can put it on
Happy birthday,
Facebook.
mom. You're the best. I'm sorry, I'm the worst, but yeah, I'll talk to you soon.
Happy birthday to Shy's mom. Love it. Cinco de Mayo B-Day. It's a party.
I know it was very easy to remember her birthday because I remember it's just tacos.
Yeah. How was your trip back to LA? It was good to see you in New York last week.
Yeah, I mean it was definitely. I was in New York for 8 nights. I was a
Whoa.
resident essentially. Loved the industrial jungle. Or concrete jungle. I got sick AF for
Oh
sure. I'm
no.
recovering slowly from it. I hate it because this week is one of those weeks where I'll be smiling or crying at the end of it. 60% of my portfolio is reporting their earnings this week. Starts with Palantir this afternoon, and yeah, things are not, things indices, SPY and QQQ is right at their 200-day moving average. All the growth earnings starts this week. Like it's going to be a chaotic week, and now I might not be able to see any of my Bollywood movies anymore because of the tariffs. So like, I am just digesting a lot of new information today.
It is a lot for you. Also, the Clippers lost, so I wasn't
Oh,
gonna.
okay, I'm
So
very
just
tilted now on that
yeah.
because James Harden does not perform on Game Sevens. I'm
He used
pissed.
to be on the Brooklyn Nets, and I had season tickets, and I was just like, dude, this guy's a bum. But that's okay. You had a good run. My Knicks are playing the Celtics tonight. That should be a
Oof,
war.
it's gonna be great.
But you're right. Like everything's happening. It was the Kentucky Derby. Did you bet on that?
I didn't because I am not a degenerate anymore. If I feel like if I was a degenerate, I'd go hard on the horses for sure. But no, did you?
I didn't bet on it. I watched it. Someone next to me, I forget what the horse was, 40 to 1 odds, and he kept coming up, and I was like, oh man, I want this guy to win so bad, and then he didn't. But
Did you
something
go
to.
out? Did you go out and watch it
I had
somewhere?
a birthday party, so my friend and I stopped at a bar before and watched it, but did not bet on it. So it's one of
How
those
big
things.
was your hat?
No hat, no hat,
You didn't
because
celebrate it.
well, the birthday party was a different theme. The birthday party was themed tariffs and tiaras. So it was like you could dress like roaring 20s or you could dress like the recession. So I couldn't do the derby and that, but yeah, it was a good
That's
weekend.
such a clever theme. Good
I
for you and your
know.
friends.
It was
Jeez.
it was a great B-day. And it was a great week in the markets. Monster week. Erasing April's post-Liberation Day losses. 9-session S&P 500 winning streak, the longest since 2024. Software tech earnings leading the charge. We heard from a lot of companies. Let's get into your outlook for this week though, Shy, because as we talked about, this is a big one for you. So you got the 9-day win streak going. Tech is ripping. Trade tensions were cooling. Now we got the tariff on Hollywood thing, which we'll get into. But do you think this rally has real legs, or is this kind of we're coming up on a sell in May moment next week potentially? And what are you looking at from last week to help inform how you're thinking about this week?
So I might be the minority in this, but I don't think nine straight green sessions is a bullish thing. I think it's a reflexive rally that we just witnessed. I believe that we are still under the 200-day moving average. Like even right now, like we got rejected perfectly at the 200-day moving average on the Qs just on Friday, and this morning, QQQ is down almost 1%. So you've seen the past like bear market regimes, like in 2008, certain segments of 2022, because that was a little choppy year. Like counter trend rallies often look very convincing up until they hit the 200-day moving average. That level isn't just a random TA. It really is where reality sets that if this move is real or not. It's where short covering ends usually, which I think this rally we've experienced since April 7th is a short covering. We were way oversold. You guys heard me on the show call out that daily RSI is at a 20, the weekly RSI is at 25. Anything below 30 is oversold. So both the daily and weekly were flashing signs of a lot of fears being priced in the market, and the VIX was at 50 handles. Like we were oversold, and now we're seeing a short covering. But now the real move, like the easy move was made. Now the real move is what's next? What's the next catalyst that's going to drive this market through the 200 moving average and potentially to all-time highs, which Tom Lee predicted this morning. He thinks we're going to hit this year, and I think macro is going to reassert itself, and I think forward expectations are going to start to matter again. In this earnings cycle, we have gone good enough prints, but nothing to really push everyone of like, oh, things are great. These are back to normal. And I think that we're just not there yet. This is what makes me so precarious where, I don't know, we're caught in the in between, the gray area. The rally feels strong, but the foundation still feels very shaky. Like that really hasn't changed much. I think mega cap earnings, we're still digesting it. It was a mixed bag across the board. You can feel the global capex is somewhat slowing, or there's a second guessing that's happening that's causing paralysis. China and the US isn't finalized. Like it's getting, there's a sandbox now to negotiate in, but it's still in flux. So like I think that their whipsaw is going to continue, and you can't just believe we're back to the golden era or the good days before this tariff war began, because like that's not the new environment. So I do think that short-term setup feels tempting. The long-term opportunity is still unfolding, and again, we're a much better spot than we were before a month ago, because I didn't know how much we would spiral because nobody, they're just making up numbers in these tariffs. But I think it's presumptuous to think that we're in the clear. And this morning's action getting rejected, the 200 moving average actually kind of makes me bearish. And if I might actually buy some hedges right now, because I'm very defensive under the 200 moving average. And as long as we're below that, like I just don't feel like I'm in position according, even with a 12% cash position, like I think I should be hedged a bit. So I'm going to be looking into that today.
Yeah. I mean, everything you say was such a mixed bag. I think some of the positivity among big tech dominated the headlines. Microsoft beat their cloud revenue, grew 22% year over year on AI demand. You had Amazon beating with strong demand on essentials, potentially people getting ahead of tariffs. But then there's always the other layer to that. Amazon reduced their volume with UPS by 50%. UPS is going to lay off 20K people. There's always different sides to this, what's going on. And one thing you mentioned, Shay, was CapEx. And one company that's not dialing back is Meta. So they said they're increasing their AI infrastructure investment, and they're adjusting that to be between 64 billion and 74 billion in 2025. So they are doubling down in their AI infrastructure. You've talked about them a bit with Llama. Did that news surprise you at all?
Well, those numbers sound huge, but guys, they print 70 billion in cash every year. So essentially, what's their cash position from right now? Meta has a, jeez, yeah. So they have essentially 70 billion in cash, so just straight cash. So they're using this year's like net income to just reinvest into AI infrastructure. It makes sense to me because they're trying to tackle AI or the infrastructure angle of it with an open source lens. And in order to do that, you kind of have to make sure you are have the widest scope, and you have to be like someone in the top tier. And what else are they going to do with the capital right now? Like they don't need the cash. They kind of are treating this year as an investment year, and it's going to bear fruit. Like that's the one thing that's not getting cut in its tariff environment is AI investments. AI. It's a safety blanket. And when their competitors are kind of suffering because they have a more of a consumer exposure, they're just doubling down, pressing on the needle of like, oh, we're going to continue our AI trajectory on our investment. So not surprised to see that, but however, like that is not what you want to hear as a Meta shareholder, where their consumer side of their business, like it's not immune. Like you see YouTube is exposed to ads. Same with like they're very ad exposed, and ad is one of those levers that get pulled if you want to reduce your expenses in a recessionary environment. So like there is somewhat risk associated with what Meta is implementing this year of like not cutting down their capex spend, but there is, if we hit a recession, their top line will get affected. And I think it's tricky though because like I said, like I'm looking at their margins. Like I don't know of a company right now that is growing the top line 14% with 35% net income margins, printing 65 billion in cash every year. That's incremental. So literally in 2 years, they're going to be having close to 200 billion in cash. Next 3 years, 200 billion in cash just added to their balance sheet. That's, you have to do something with that. And what do? Invest into the one safety blanket that doesn't matter what the tariffs is going to do to it. And that's exactly what Zuck's doing.
Yeah, I mean, it seems just like an interesting exercise to deploy that amount of capital in such a short amount of time. Like, it feels like, I don't know, do you think they're trying to play catch up, or they're like, hey, we're pretty cash rich right now. Everyone else is kind of on their heels. Let's just hit the gas in 2025. But that is a lot of money to invest in. We're halfway through the year now. So that was wild to me. I did a double take when I saw that number.
Yeah, so I do think that we're still in an arms race for AI. So if that's why I was like, I saw his FUD for CapEx during this like tariff war initially. I was like, guys, like you can't just, it's not a flip of a switch. You can stop your AI CapEx spend. It's like if you have a $100 billion CapEx spend for this year and you've already committed 40 billion of it, are you going to pause and wait until those macro environments provides clarity? No, like it doesn't make sense because that first 40 billion you spend will be sunken costs. That's too much risk. And all of a sudden, you don't know in a month or so, like things will go back to normal. Then all of a sudden you miss out on that 1 month of pausing, but your competitors probably continued pushing along and now you're catching up from behind. So it's almost a way of like the more dollars to spend in R&D or CapEx, I'm going to make sure I'm staying ahead of my competitors. And nobody really knows the ceiling on AI. They just know it's going to be substantial. It's going to be structural shift across so many different industries that as soon as we get more clarity on how what the AI ceiling is going to be or what the reality of AI will be in implement enterprise and consumers, like we want to make sure we have all the tools necessary in order to make that pivot. So I think this is somewhat bullish on Nvidia, where Nvidia has all these headwinds now, narrative headwinds that you're seeing signs on big tech that yeah, they're maybe plateauing capex spend, but there's zero reductions, and in some cases there's some increases, like you mentioned in Meta. So it's like the party will continue for this year for Nvidia, and I think, do I get into this opportunity at 112 for Nvidia? I don't know. I feel like it's being used as a political trade now. When compute is the new war currency, who's going to be the sacrifice? It's Nvidia, who's the kingpin of the new digital economy. So there's a lot of it that's out of their control that Trump's going to use as leverage. And unfortunately, that's like not what you want to hear as an Nvidia shareholder. And people are confusing narrative false price action and see stock like dipping significantly this year or the past couple of months, thinking, oh, the business is a commodity. No, it's just being used as a political pawn. And that's the most frustrating thing as a shareholder, that there's nothing you can do and just wait it out.
Yeah. Let's stay on AI and the future defense because obviously it's a big week and a big day for Palantir. They're reporting their Q1 earnings after the closing bell today. In Q4 2024, their revenues were exceeding $860 million. That was a 36% year-over-year increase. Analysts are expecting continued growth driven by AI demand. Looking at this earnings, some people are cautioning about their high valuation levels. Shay, I know this is a big dog for you. This is a big dog in your growth portfolio. What are you going to be looking at when they report later on today?
Yeah, so Palantir, no matter what how much I trim, it still maintains my number one position in my portfolio. It's just one of those dogs. It's just catching a bit. And I made a post last week. It's funny because like dumb money is slowly becoming somewhat of the smart money, where a lot of the dumb money, myself included, bought Palantir under $10. Who's buying Palantir above $100? the smart money, because now that they saw that they are becoming the operating system of AI, they're now, if you want exposure to Palantir, you have to just pay a ridiculous premium to get that exposure. Where dumb money didn't have to. But the bigger question now is, when does fundamentals come to play for Palantir? Because at $350 billion market cap, again, wild, love to see it. But to put it in perspective, Snowflake, CrowdStrike, Robinhood, and PayPal, combine them all into one company, it's worth less than Palantir. So Palantir is massive. It's a massive company. So you need to ask yourself what's being priced in. And right now, what's being priced in is, you guys heard me talk about CUDA all the time, NVIDIA's software component of their ecosystem. Like, what CUDA did for compute is what Palantir's AIP is going to be doing for enterprise AI. So the issue is the architecture of that is being built right now. Deployments are absolutely real, but the valuation is reflecting that reality. And it's not like what it was in NVIDIA in 2017, when the market was still kind of playing catch up to what CUDA would enable in the new digital economy. People still viewed NVIDIA as a gaming chip company 8 years ago. Right now, Palantir isn't being reflected. Market isn't playing catch up on Palantir. It's being priced accordingly, that they will be an operating system of AI. They're going to be growing 30% top line for the next 5+ years with 40% margins. And that is something that's what makes this moment so critical, because now the $1 million question that I just brought up earlier is like, when does it start getting valued like a mega cap? When does a business scale into the expectations that's already priced in? Because Palantir is making $4 billion this year. That's 1.5% of their market cap. So it's a
Wow.
valuation. It's a very expensive company. It's a valuation typically reserved for like dominant platforms, which again, the kind that you can't replace, aka monopolies, massive moats. But that's exactly what the market's pricing in right now. So like, even if, which I do believe, AIP will be a central component to the enterprise AI workflow, as I don't know, Microsoft Windows was to computing, as cloud computing back then, as what CUDA is to AI compute. The issue is like it's priced for execution, and there's no room for any kind of error. If you're buying Palantir today, which I do not advise, but if you are, you're not betting on a turnaround or kind of narrative shift. You're underwriting legit like a 7 to 10 year window of high margin growth, rapid expansion of their commercial adoption, platform lock and scale to the effects of what Microsoft was in 2000. And you're just betting they're going to be the new AI backbone for the modern enterprise. But the thing is, like, they might pull that off, and that's great. But if they do, it might be a $500 billion company. But if they don't, it's going to go back to $40. I don't think it's going to go down. It's ever going to break $50 again. But I think there might be a dead period. Like, I really do think there might just be a consolidation period of years until the valuation catches up to that. And that's fine. You guys should be like, this stock is 10x in the past 2 years. Like, it's not like an NVIDIA where everyone front runs their CapEx spend this race. Like, Palantir's business approach is it's not snail like, but it takes time. It's an operating system. It's not just you sell a chip and like now it's up to companies to do whatever they want. Like, they get infused into every enterprise white canvas approach, and you guys work together to figure out how to optimize all their efficiencies of that organization. Like, that just takes time and it's expensive. So I think the risk and reward isn't on the reward side, but it hasn't been for a year. At past 4 earnings reports, people have been like, oh, it's going to down 50%, 50%. Look at the chart. It catches a bid on earnings, consolidates for a couple months, and then the earnings proves like, whoa, it's accelerating again, and it catches another bid. So like, this could be a $150, $160 stock after this upcoming earnings. And I think it's almost one of those names where you just have to wait on silence and just praise to the earnings gods that they'll give you some kind of dip opportunity due to some kind of macro environment issue. Like, I don't know, maybe Doge wasn't as much of a tailwind as for Palantir. Is actually somewhat of a headwind in the near term. I don't see that, but maybe, or that paralysis that enterprises are feeling, like it's making them not want to adopt revolutionary platforms like AIP, and they're just going to sit on the sidelines until there's more clarity in the macro environments. And maybe that's the opportunity, a window to get into the stock because commercial adoption is sh- showing signs of slowing down, but really it's because of the macro environments. But I don't know. It's like I said, their revenues for it's like 1.5% of their market cap. It's a 12% position for me. I've trimmed 50% of it at $70, $80. Like clearly too soon, but like I wanted this position to be all profits and forget about it.
Mhm.
So that's what it is right now. But
You
it's
can't quit
defying,
it.
yeah, you can't quit. It's defying all expectations, and
Yeah.
I just think it's a tricky one to not have exposure. And if you're all in on the fourth industrial revolution,
Yeah, and the analysts are predicting more of the same around, they're predicting around a 35% year over year increase in revenues. And so that, all things happen according to how they should happen later. Who knows? Anything can happen. But to a point you make a lot on this show, Shy, just the infusion of their technology and how embedded they are within their customers is very, from a software standpoint, that is a very powerful moat when it is very hard to untangle from something, either because it's so embedded in the business or you're so reliant on it as like an existential product. And you bring up CrowdStrike as an example too of if these technologies are working the way they are, you don't hear about them because they're preventing and they're de-risking. And so it is interesting to think about scenarios in which Palantir is not able to live up to its hype. What would need to happen for that to be the case? And anything can happen, but it's a tough one. They're on a good path. That's why it's so expensive. But you're saying if you're not in Palantir already, you might want to wait and see what happens.
yeah, I mean, first off, like Palantir's green pre-market, it hit an all-time high. The Qs are down 1%, but I think again, when we had that macro pullback just a month ago, that was your opportunity to reposition to the clear winners because winners don't give you opportunities to pull, like, be down 30, 40% unless there's some kind of macro environment that takes everything down with it. That was the opportunity to reposition your portfolio. Yes, Palantir at $70 was like, whoa, no, like that's crazy. But it's at 124 now, a couple weeks later. Like winners keep winning because you want that exposure into specific early sector growth themes with a ton of runway. And when there's a name like Palantir have cemented themselves as one of those like five names that would come out of this thriving with unprecedented pricing power, you need that exposure. Like I, there's an AI tsunami that's going to hit software space. Like people are still like not underwriting it, but like I think there's going to be a handful of names that will come out of it strong, but the majority, like 85 to 90% of the names, it's going to consolidate and it's going to be dead money. Like it's going to be. There's software is in trouble. SaaS will be in trouble, and I think that Palantir have cemented themselves like we're not going to be in trouble. We're going to actually be thriving in it. That's why there's a pricing premium that the market's assigning to them because there's no AI tsunami heartburn. Another one so far is Cloudflare. I mean, Cloudflare is another ridiculous valuation, but they have a monopoly in what they do, and they're kind of building the AWS of the new modern internet. And that is a name that just like valuation doesn't take too much of a factor into decision making, but it's not really a SaaS, it's more of an infrastructure player. And that's why like, I am repositioning my portfolio in a way of the I call the bucket the new age of defense because it's the stickiest component of any IT budget. It doesn't have a consumption as much of a consumption exposure in a recessionary environment where like I love Snowflake, but like Snowflake might be in trouble in the next 3 to 6 months. Like AWS and Google Cloud numbers were weak. They were weak this on the top line, guys. Like it's not diluted. It was weak, and I don't think software is going to be a great place to be in for the next 3 to 6 months. This paralysis that executives are feeling, that you instantly feel that in SaaS, and especially stocks with a consumption model. Cloudflare, like you, websites are powered by Cloudflare, and they're a CDN, and in this agentic AI world, like you're going to need to use them to reduce the latency between AI agents to AI agents. Like it's just it's a necessary part of the stack. So I think you need to position accordingly. New information comes to light every month. You have to be flexible. You have to be diligent with what you're going to do. I love Snowflake. I don't know if it has to be a top five position for me in this environment. I just don't, because you have to see, you can't be emotional. Like I learned that. Like I've been holding Unity since 2021. Look at what that has done for me. I should have bounced to go App Lovin when App Lovin was showing clear signs of monetizing mobile games, when Unity had the worst freaking management, but I was suckered into the duopoly they have in the gaming engine. And I was like, they have a duopoly. I love monopoly and duopolies. They're gonna figure out the ads part of their business. They just never did. Guess who
Mm.
did? App Lovin. Do I say App Lovin's a better opportunity than Unity right now? I don't think so. I think Unity has a lot of FUD factor into the stock, and I think right now they're probably at the top of every M&A list in big tech, because they have incredible technology, poor corporate governance. That combination is gold mine for large cap M&A. So I think they're going to right the ship. They're reporting this upcoming earnings this week, but I mean, I think Unity was a great lesson for me specifically on like, you doesn't matter how much I love the technology, underlying technology, like the opportunity and environment has to become a bigger way in my decision making. And SaaS is not where you want to be in the next 3 6 months in this kind of macro chaos that we're in. And I'm either going to be raising cash position or reallocating it towards the new age defense bucket, or the safer names like the Amazons, which is like my beach stock.
Yeah. Well, we have some breaking news out of a company that I'm sure is a big part of your portfolio,
Oh
Shy.
God. Tell
Footwear
me, is it good
giant.
or bad?
No,
Oh, you're
footwear.
talking Skechers?
Yeah. No disrespect to Skechers. I just when there's a Skechers joke right in front of you. Footwear giant Skechers is going private. They got acquired by PE firm 3G. They were actually, I think they were doing pretty well in the public markets. Um, so they're gonna pay $63 per share in cash for Skechers. If you've been in Skechers a bit, I think you're sitting kind of pretty. We pull up the chart. 30% premium. And yeah, the deal is not closed yet, but on its way. And all right, let's. I don't know if Skechers needed a turnaround. I
Well,
know they're teaming up with Snoop Dogg. There's Snoop Skechers. What's the need of PE when you got Snoop?
well, this was actually part of my thesis of Skechers, because I thought they were going to be the premier footwear for humanoids. So now I'm like, I need to figure out who else will. No, I mean,
It
I
is
think
true because they slip on. You don't need to be able to tie. You just like pop into them, and some of them have little wheels on them for extra mobility. So
I mean, in all seriousness, guys, like retail is kind of screwed for a bit. Like you're seeing Nordstrom go private, you're seeing Skechers. Like there's there's no world where these kind of stocks should be in the public markets in this macro massive environment, especially with tariffs. Like it's just, you're gonna see a lot of like PE firms capitalize on this kind of mess or chaos to
mhm.
take some of these assets private. Skechers, I think it's just beginning of that. I'm sure there's gonna be other retailers out there as well that would probably go private. Um, but yeah, I mean,
Yeah, that was a hard right from the future of defense. We are getting close to opening bell, but we have also today reporting today Hims and Hers. Shai, we've talked about them. I know you're a self-described perma bear, but you had some thoughts on Hims over the weekend that you shared on X. What are you looking at as they get ready to report?
yeah. So I'm a long term bear. You guys all know that, but I liked, even with all my bullish positions, I asked myself, how can I be wrong? Same with my bearish positions. Like, how can I be dead wrong? So, Hims, you guys, I'm not going to get into my bearish thesis. You guys heard it. It's just, I think pricing and convenience is the two pillars of consumers for telehealth space. And I think Amazon will disrupt that drastically for Hims. And that's going to affect their margins and pricing power. And you're going to see a lot of DCF models get revised because of it, because they're not going to be able to produce 70% gross margins anymore. It might be 55%. So I think that the bullish case of what could work, again, you see the name Netflix a lot for Hims and Her Health, like the Netflix of healthcare. So think of Hims not as a clinic, but like as somewhat of a pharmacy aisle of the internet where you get the front door to the digital eco- healthcare economy where you can get weight loss, dermatology, sexual stuff, mental health,
Sorry.
but not like siloed categories, but like literally all these different storefronts under one umbrella, which is Hims and Her Health. So I think that if like if Hims doesn't need to serve everyone, that could be Amazon's job because Amazon's uh, ex- ex- hands is in so many different things with Prime. But if Hims can figure out how to serve someone individuals better, that could be the way to be Amazon proof. Where Amazon might be able to offer convenience, but like it doesn't have the patient intimacy, it doesn't have the specialty credibility, it doesn't have the consumer trust in highly sensitive categories like sexual stuff or mental wellness. Like Hims
True.
has that. So if it can scale that trust into drug agnostic, outcome first, like some kind of vertically optimized marketplace, then it becomes not just a healthcare platform, it becomes the platform where modern healthcare is consumed. But that's a big if. But if they can solve that, then maybe, like just maybe, this isn't a death nail in him's coffin. Like then maybe this is the inflection point. Maybe this is what Apple Music provided for Spotify, the gut check, and now Spotify came out
Hmm.
strong, and now they have a mode. Like this is one that doesn't like maybe Hims doesn't just survive the Amazon age. Like they actually define what comes next. Either way, like I think where my eyes go is on the gross margin. That's where pricing power lives. It either holds or disappears in a space that's definitely a commodity now, which is telehealth. So I think it's it's either on like a $200 stock or it's a $20 stock. Like there's it's one of those most polarizing stocks out
Yeah.
there that if it works, wow. If it doesn't and becomes a I don't know if it's gonna become a teledoc. It won't become a teledoc, but it's going to start being priced as a commodity, and that might be dead money. But yeah, I mean, the
I think
it's
they might be thinking along the same line of thought as you, Shy, because I'm now seeing a headline that they are appointing a new COO, and this person comes from Amazon. So Nader Kabani is the new COO effective May 19th. Notable tenure at Amazon. The press release saying they're set to enhance the company's operations. So this person actually spearheaded Amazon's entry into the pharmacy sector. So this is
interesting.
just as breaking news, but led the acquisition of PillPack launched Amazon Pharmacy. So I think they're thinking like you are, Shy, and like let's get the person that did this and get them to do that over here.
I, I mean, if only there was someone in corporate strategy for United Healthcare, they should probably be
I,
poached. You know, no.
But they have been. I mean, that's one move. And then last week they did have a pop because they announced they were teaming up with Nordisk on a collaboration. To your point about like building that trust, can they borrow some trust from existing players? So I think that's an interesting one to watch. And we know you guys get really fired up about Hims. I don't know if you guys are customers personally or you just like the stock, but a lot of chatter in the Stocktwits community about Hims. So as with all the earnings calls that we've been talking about, Palantir, Hims, like you can listen to all those in the app. Talk about it. We didn't even talk about like what Alex Karp might say on this call because I feel like every Palantir earnings call is he's got some other crazy line. So I look forward to that personally. But we got two big ones coming up, and that's only Monday. That's only what's happening Monday. We look ahead Tuesday, AMD and Supermicro. Shai, how are you thinking about those two? I know you've talked about those companies quite a bit.
uh, I mean, AMD is just such a story stock. So you need to see some data center revenue finally beating and accelerating. But I think that's dead money until they figure out the software. Their inference is going to be a massive tailwind. for like AMD and Nvidia. Nvidia's set up perfectly to capture that via CUDA. I don't know how AMD's really captured it with their open source product version of CUDA. It's just so much below the standard that you need. So I think machine learning and AI is really difficult enough to solve and like to create those product go to market products. Like you don't go bottom fishing in AMD's offerings. You go pay for the top quality, which is Nvidia's CUDA, and that's why a lot of people who get Nvidia's chips, they stay in their pricey ecosystem because CUDA makes them stay. And if you're buying the hardware for Nvidia, you're using their software as well. Like, why not just use everything else? And that's kind of Nvidia's pitch. So AMD, it's cheap. It's so freaking cheap. I don't know if it deserves a premium because you can't just be a hardware company anymore. You need you need a full ecosystem, and I don't believe their ecosystem vision right now. I just don't. SMCI, why would you ever invest in that shitco? It's just you can't trust what they say. You can't trust what they report. They already I think they pre-announced already. And it was ugly numbers. And they're again, you can't just be a hardware company anymore. You need an ecosystem. And end of the day, like they're just it's a hardware offering that's low barrier of entry for the HP and Dells to create. And their whole thing has always been the quickest. Would be the quickest. Da 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 da. Now, like Dell and HP can offer so many different things around similar kind of server offering, that customer service, convenience, all that stuff. What is the pitch for SMCI besides the NVIDIA connection? Because I think they might be cousins or close. I don't know. The CEOs are really close for some reason. The first mover advantage is no longer an advantage because everyone's caught up. So now it's gonna be tricky and it's gonna look dirt cheap. But the reason is because servers are a commodity. It deserves to be cheap. Other than that, for this week, let me look through the calendar.
We got
Uh,
Celsius tomorrow, which is
we do have Celsius.
I
Interesting.
don't own the stock, but I own a lot of Celsius. And they're coming off their Alani new acquisition. I always like following the beverage energy drink wars. It's one of those products that is basically a drug. So very interesting to see those trends over time. Ford is also reporting today. I mean, it's crazy. ARM, Semiconductor. Do you have any thoughts on those guys, Shy? Do you have a position in ARM?
Software is catching a major bid right now. Sorry,
No,
I was
keep
planning on
going.
trimming soft. I was planning on trimming software today because I think it's gonna be a weak earning cycle. But yeah. So Celsius, you guys, they made that acquisition with that product. I'm forgetting what the product it is, but my fiance told me
Alani
it's really
new.
popular. Yeah, it's really
Yeah.
popular among women. So
Mm-hmm.
uh, I think Celsius has solidified themselves entering the new stage of their growth cycle, and that's new stage is something I have zero interest in investing in. When they wave the white flag on their product might have hit maturity, the actual Celsius product, so that in order to grow, they have to go the land and expand mode. Usually that's for like a company that's 25, $30 billion. That's when like growth really slows down. Celsius is seeing that growth slow down like at their current valuation right now. And I was like, all right, if they're adopting this business model, it's not a growth stock anymore. It won't be. It's land and expand is not a growth stock to me, in my opinion. That's why I didn't love Palo Alto as a cybersecurity name because their model has always been land and expand. And as a
Mm-hmm.
growth investor, like that's just not my cup. That's not my cup of tea. However, um, for like the Celsius out there, like it's just that's they're entering that stage. So like be aware if you're investing in Celsius, it's all about earnings expansion now. It's no more top line growth. And
There's always the
I want
commentary with them too around their deep partnership with Pepsi and whether there'll come a point in time where Pepsi just takes them out.
well,
Uh,
you have to ask yourself like why didn't Pepsi buy more of a stake in Celsius during this dip? That's a big
yeah.
that was like I was waiting for that. As soon as I got that sign, okay, maybe they're gonna reaccelerate top line growth because Pepsi had them in a chokehold. We didn't get any increase of stake. That was like, all right, well, that's somewhat telling to me, and it's off my radar now. I don't even watch the stock anymore. But other than that, for if I want to pull up the earnings cycle again, I think ARM is going to be a great stock. It's really expensive, but they essentially provide the blueprint for the digital economy. They will be there always. They will always be there. But Semiconductors really didn't catch that much of a bid this cycle, so like, I wouldn't be surprised if they didn't catch a bid. Same thing with Arista Network. I think the networking component of the semiconductor ecosystem is very important. They'll do well. Tempest, Grandma Pelosi's favorite pick, and I love that as well. I have it. This is not a quarter to quarter story. This needs massive insurance regulation clearances to really catch a major bid, which again, insurance reimbursement initiatives to really catch a bid. And if Pelosi's invested in it, I think pillow talk wise, like something's coming down the pipeline. You never know.
Mm-hmm.
Datadog is we had Confluent last week. Confluence is more of a niche play in the software space for consumption models because it's just streaming data, and their open source Kafka is like widely used across Fortune 2000 customers. But managed source of that is somewhat of the jury's still out there if you need it. That's what Confluence whole spiel is the managed source side. That was weak. So I don't know if that's a streaming data issue because open source Kafka is so widely used, managed source isn't that necessary. Datadog tomorrow is a big tell in software space. So that's going to be a major tell on what Datadog does is observability. Essentially, when you migrate into the cloud, they make sure you don't overspend on the cloud. I'm long term bearish on Datadog because I think AI agents will replace them essentially. That's one of those AI tsunami I'm talking about. It's a perfect example where you can create an AI agent to prevent yourself from overspending on a cloud service provider. Maybe not 100% of the time of what Datadog does, but I don't know, like 80, 85, 90%. And that's enough to make it worth it where you don't have to adopt the pricing that Datadog has. And Datadog isn't cheap. They have an incredible go-to-market strategy, and that's probably their moat that they have where observability is a very crowded space where cybersecurity names out there, their new modules are observability. CrowdStrike has an observability module now. It's not hard to create something similar to what Datadog has. But Datadog's go-to-market strategy is chef's kiss. I just think AI agents will replace that, or it's going to become such a commoditized product that it's not going to have a premium valuation anymore. And
You don't
Datadog
think
is
it would? Oh, sorry. Go ahead.
No, go on.
I was going to say when we were talking last week about when Dan was here, ServiceNow and them building in embedded AI, agentic AI. Do you think Datadog is in a position to do something like ServiceNow is doing, or do you think they're not? It's not the same type of business to be able to pull that off.
Not same type of business because I think ServiceNow is such a blue chip in IT management that they're such a important part of the stack where Datadog, like ServiceNow doesn't really have a competitor. It has no competition really. Sure, there might be a little smaller players, but not really. Datadog has observability is a crowded space. It's very crowded, especially when a lot of cybersecurity companies are kind of creating a similar product. AI agents are going to create a similar product. You can't create an AI agent for ServiceNow, really. You can't. It's very messy. Preventing overspend on cloud, like that's a very agentic AI feature that can be solved.
Mm-hmm.
I don't know if it's reflected in that stock. I was pretty early on that assumption. I think I made that assumption last Q4 of last year, but I sold my position when I was like, I see that I think this is going to be a headwind. I don't see a future in Datadog anymore. I could be wrong, but I sold my position. But yeah, this is one name tomorrow. Like we'll get signs of how the consumption is doing in the software space for business spending. When there's a paralysis happening in C-suite, that's going to affect software names with a consumption model. Even if it's a couple day delay on something you thought you were going to do, that snowballs across the board. And all of a sudden, that consumption model becomes a headwind when business spending is on pause a bit. Datadog, Confluence, Snowflake, MongoDB, these are the names that will have somewhat of a short-term headwind. And that's why I wanted to trim like some software names today because like I just don't see a world where the East versus West is going to be finalized by the summer. And if it's not finalized by the summer, like that's not just this earnings cycle. Now it's going to be next earnings cycle. That's going to be a headwind and it's going to be dead money. And we're under the 200-day moving average. So like I want to be defensive. So like it's
it's a tricky time. Like I have to be so freaking versatile. And as a long-term investor, I'm investing 5+ years out. I'm making a lot more moves than I'm accustomed to. Is because the board is slightly changing week after week, and we're getting new information. And I think at Snowflake at 170, like I could see a world where it hits 120 again if this like East versus West prolongs into Q4 of this year. I see MongoDB maybe hitting $100. You never know. That's why I'm just repositioning my portfolio into specific segments where it's somewhat defensive and it's kind of protected from the consumption model or the IT budget changing, and have to plan accordingly.
Yeah, you almost do have to pick your battles this week. So looking ahead, also on Wednesday, in addition to ARM, Disney. That's going to be a very interesting one to watch there. I think they were pre-market down slightly on the foreign film tariff news, but also they would see impacts in their parks division on potential consumer pullback. So that's happening on a Wednesday. We also have Uber reporting, Novo Nordisk, Shopify. Shopify is another interesting one to watch. That's a lot of small businesses, although they've expanded to have enterprise customers. That's a very well-run company. They tend to perform pretty well, but again, like that's another place where you're transacting goods from across markets. They're very global. That's going to be a very interesting one to watch as well. And then, of course, we've got Coinbase and DraftKings. We got to talk to Robinhood CEO Vlad Tenev on Friday, which was very interesting. We can kind of share some of the takeaways from that, but the full video is up. But Coinbase is another one. One of the points Vlad made was just talking about how they're building, as we've brought up on the show, Shy, like, are they trying to be the Amazon of money and transacting and owning things? And he said, absolutely. Even in the earnings call, he said that they reference Costco membership and American Express and Amazon. American Express, I've added that in. Amazon as reference points. And so they see crypto as a very important part of their business, but it's a piece of the puzzle. Coinbase is obviously all in on crypto. They were early. They helped push this forward. But you wonder if now that lack of diversification hurts Coinbase. Do you have any thoughts on Coinbase in particular, Shy, or even Robinhood? They had a great readout last week. Any thoughts there?
Coinbase is not going to be the ecosystem people envisioned a couple years ago. I think Robinhood's kind of capturing that. I think Coinbase is a vehicle to capture Bitcoin performance. I think there was a world where NFT marketplace could have been huge for Coinbase. NFTs are dead, probably forever. So I think they're heavily exposed to the cyclicality of crypto. I think Robinhood is kind of, yes, they make the bread and butter on the crypto spreads and like they weaponize volatility just as much as Coinbase does, but they're expanding their ecosystem in ways that Coinbase is not at all. They predictive markets. They're stepping on DraftKings' toes a bit. Robinhood by offering that. They took me away from Chase Sapphire card with their new credit card. That's a 3% cash back on essentially everything if you're a gold member. I'm a freaking gold member because I love Robinhood's UI experience. My capital is so much higher than it was a couple years ago when I started Robinhood, but I won't leave it because I love the UI experience. It's, even though I'm not a trader, it's pleasant when I buy stock and what it looks like. And like, I know investing is supposed to be boring. You're supposed to be in Fidelity or whatever boring other brokerage it is. Why can't you have some flair and adding a stock? Like, it doesn't matter how much capital I have. Like, I'm probably going to be continuing using Robinhood, maybe nostalgia, but mainly because the UI experience is tier one. Everything else is like, whatever. It's like driving a Camry versus driving a Tesla. Like, I rather get from point A to point B in some style and like luxury rather than going from point A to point B in something that's just like vanilla.
Yeah, Vlad was talking about this idea of gold bringing mass luxury, like his mass luxury concept. Like, he talked about tokenization a lot, owning a piece of real estate someday through Robinhood, a sports team, things that only uber wealthy people could do. he wants that to be possible all within this one ecosystem, $5 a month, which is a cup of coffee. In most markets, probably not in New York and LA where we are. Mine was $7.40 this morning, but it's fascinating to think they're thinking so much bigger than brokerage. And to your point on the UX, I think there's so much nuance to that conversation that we've sort of evolved past. But I remember, 4 or 5 years ago when people were losing their minds over the confetti once you made a trade. And it's like, I understand where that argument was coming from at the time. But I do think technology needs to adapt for new generations of consumers. And they're building experiences, products, and features that are meeting needs of new customers. And one of the points he made was that this idea, and he's written about this, the American dream used to be, I'm going to own a house someday. It's going to have a fence. I'm going to have a dog. And that's going to be, I'm going to look at that and say, I own that. That's my nest egg. That is so far from where we are right now. And now it's people want to look at a bunch of things that they own a part of across stocks, crypto, ETF, maybe real estate, maybe VC, PE. It's just way different. And so they're envisioning that future and building what they think is going to be the place for it. But it is, they're coming after everyone. Like if, on the banking front, like if you got an 18-year-old kid coming out of high school, are they going to open a Robinhood account or are they going to open a Wells Fargo account? That sucks to be Wells Fargo. When I think about that challenge, I would love to be in brainstorms about how they're thinking about that. Like, how do you compete? Because now this is the brand for young people. And it's interesting because the risk for Robinhood back in the day was, it's not a known brand. There's no trust. It's been 5 years of them, building, shipping. They haven't had a huge snafu after the GameStop thing. But I think about those larger financial institutions and I'm like, what the hell are they going to do? I don't know. Like if you're a corp dev at some of these companies, I don't know what you do. It just seems like a very, very hard challenge.
You're lagging a bit. Sorry.
Sorry. It's okay.
Towards the end, but I'm hoping I'm not talking over you. But
you're not.
No. Listen, brokerages is a commodity. It's a B to get your money out of a brokerage to somewhere else because of a couple-day delay. But what's a moat in a brokerage model? It's marketing. It's the experience. It's the ability to communicate a new product and have excitement around the new products. Again, like there's a battle that goes on SoFi versus Robinhood. The main difference is leadership. Vlad's a showman. Noto is an operator. Doesn't make the SoFi product any less than Robinhood's, but in the eyes of a lot of retail investors, they feel the vibe, the energy, the aura of all these Robinhood products, and they believe in it. Because Vlad's a salesman. He's a showman. It's great. You want a founder-led CEO who's a showman. That's why one of the annoying things about Snowflake shareholder is like we never had a showman, founder-led CEO who's a showman. Databricks, they have that, and that's why Databricks has a lot of momentum. Momentum is built on a narrative. Narrative is built by a CEO communicating a message. That's so important in this new future economy where the new currency is eyeballs. So how do you capture as many eyeballs as efficiently, as effectively? It's by having a flair. And that's essentially, Vlad sees that and he's implementing it. And the world is technically the TAM. That's half glass full. I'll end. We're about to end here, but like the one issue is still like there's a cyclicality risk still associated with Robinhood, even if they're trying to capture degeneracy essentially, or not degeneracy, just like the world's appetite for improving their life. Let's just say that if in a recession environment and people don't have the discretionary income anymore, they will be affected. So
yeah,
I think he's doing everything perfectly to get away from being in one lane and becoming the all-in-one financial ecosystem and constantly innovating, constantly launching new products to make it bear fruit in what his vision is. But end of the day, you have to ask yourself, like, what's the risk? It's still cyclical. And also, the year-over-year comps are going to be very difficult because he had such a strong 2024 year. Mm-hmm. Even like it's going to be hard to keep topping in. shareholder expectations unreasonable, and they always want more and more and better and better.
Yeah.
At a certain point, it's gonna be hard to pull as many levers as they pulled the past year, and just be cautious. But I love if you're a Robinhood shareholder, great, kudos. It's working, and Vlad is the leader you want to invest in. And I'm watching from the sidelines as a spectator, but as a fan. So happy for you all.
Yeah, and that's, I think, Shy, a lot of what you said, the concerns go back to his exact talking points when we talk to us and others, is like growing the subscription, recurring, repeatable revenue, not tied to market volatility. He also talked about rolling out sophisticated product features so people can trade sideways. But you're right, there's still that anchor. So the SoFi had a good readout too. So these brokerage wars are just getting started, the fintech wars. There's so much happening this week, guys. We will be here every morning at 9 a.m. Definitely tune in on Stocktwits, listen to the earnings calls, drop your comments, your thoughts on those stock pages. We'll take a look and get to your comments on the show. But yeah, I guess have your Celsius, have whatever energy drink you have in mind, your coffee, because it's going to be a big week. And we will see you guys tomorrow morning.